Welcome everyone. As you heard, we've got 45 minutes. Now, usually I have this presentation set aside for 1 hour, so I'm going to cram as much of it as I can into this 45 minutes. Are you guys ready? Excellent. Excellent. One thing I want you to notice is this is a cool webinar control panel that Traders Talk Live has set up for us. In the upper right-hand corner of your computer screen where you see that webinar control panel, find the orange button with the white arrow. I want you to go ahead and click that button. That's going to squeeze the majority of that webinar control panel off the screen, freeing up a lot of screen real estate. The other thing I want you to do is on that vertical array of button that remains, right? I call that the minimized view or the grab tab, whatever word you want to use. There's a button that'll, when you click it, will make my screen take up your full screen. I want you to view me in full screen because I'm going to go into some great details here, and I want you to be able to see what's going on. I don't want you to have to squint at a very small screen, okay? And last but not least, you've got this hand raising button. And that's how I like to interact with people, because you could watch and you can listen, but if you sit on the edge of your seat and you actually interact with me as if we're face to face, by raising and lowering your virtual hand, you're going to get a lot more out of this. How does that sound? How many of you with a show of hands say that sounds great? Fantastic, fantastic. All right, so let's go ahead and get going here. I've got a presentation called the Discover the Exact 4 Strategies for Making Serious Investment Income. It's going to turn you into a trading pro. Now, I always start with a little bit of a disclaimer, but even before I start with the disclaimer, I want you to take a look at this graph that I just threw up in the screen. I want you to just plaster it into your brain because we're going to talk a lot about it throughout this presentation, but I want you to notice a couple things. One being that this is the zero break-even line, this little line here, that we've got a high range that starts out making profit right from day one. We've got a low range that within the second cycle is already making profit, and it goes up exponentially. Everybody got that plastered into your brain? We're going to revisit this often. If you do, raise your hand. Excellent. Excellent. All right, let's keep going then. Which would you prefer? Would you prefer taking $50,000 today or a penny that doubles every day for a month? Now, if you've seen this experiment before, please humor me. Most of us, if you're not quite aware of what's going on, you'd probably want to take that $50,000. A penny is pretty small compared to that, but let's go through the math. So in the first days, we go double, double, double. By day 5, we're at 16 cents. A week in, we're at 64 cents. We're already about a quarter of the way through the month, and we've got 64 cents compared to $50,000. But let's keep going. All right, here's day 8, day 9, day 10. At day 10, about a third of the way through the month, we've only got $5.12. We keep it going. All right, we're at day 15, which is about halfway through the month, only $163.84. If you only had a month left to live, now you've already used up a half of it, and you barely have anything near that $50,000. You got to keep that in mind, that you got to be, I mean, I'm working for the whole half of the month, and I still don't have anything near the $50,000 I could have taken up front. Let's keep going. All right, we're 3 weeks in, and we actually are starting to see some numbers now, $10,485.76. We're almost 3/4 of the way through the month, and we're still nowhere near 50,000. It's like, oh my gosh, the deadline's approaching, but let's keep going. All right, now day 24. We only have like 6 or 7 days left of the month. We finally surpassed that $50,000. We've been kind of sitting on the edge of our seat, baiting our breath through the whole month, and finally towards the last week of the month, we surpassed that 50,000, and then look at what happens as we continue to double that penny. By the time we finish, we've got $21,474,800 $836.48. Now, this is called compound interest. Most powerful force in the universe. I'm not sure Albert Einstein ever said this, but they do attribute it to him saying that. It is super powerful. And what I want you to write down on a piece of paper right now, grab a piece of paper, grab a pen. If you focus on growing your portfolio by 6% every month, not what a lot of folks will tell you like, hey, you could double your money, triple your money, make 150% on your money. Focus on 6% of your money every month. Guess what happens? By compounding simple interest once a month, 12 times in a year, you're going to more than double your money every year. Put that down on your piece of paper. Focus on 6%, you'll double your money every year. That means if you had $1,000, it goes to $2,012 in 12 months, which means it would grow to $4,048 in 2 years. Untouched, in 5 years, it goes to $32,987. And in 10 years, you're a bona fide millionaire with $1,088,187. The other cool part about this is, what if you have $100,000 in your portfolio? That means every year you're going to generate $101,219.65 per year by focusing on just 6% growth in your portfolio every month. Totally a focusable goal, right? Here's the scoop. The average income in the United States, now I know that there's some cities on the borders, not on the borders, but on the coasts, where New York, Washington, D.C., Seattle, San Francisco, LA, even in the middle, Chicago, $80,000 is not the mean wage, but the average income in the United States overall is about $87,000 as a salaried worker. Just by investing your $100,000 portfolio and earning 6% per month, you're blowing that number out of the water, and you're not having to work what comes along with an average salaried worker's time, which is about 40 to 60 hours per week. In other words, you're letting your money work for you. I'm AJ Brown. I founded a company called Trading Trainer. I'm recognized as the world's most disciplined options trader. Been doing options since 1997, 22 years. I've had this program where I publish my daily insights for my Trading Trainer participants every night. I've been doing that since 2002. And you might have seen my ebook on people's computers called The 7 Strategies of Successful Option Traders. Been popular now for 15 years. By the way, how many of you, with the show of hands, have heard of me before? Excellent, excellent. Let me ask you the other question. Put your hands down. How many of you, with the show of hands, have not heard of me before? Got quite a few new people. So let me just, this is my home study course that a lot of people have on their shelf. It's been around for a while, and it's still very much current today as it has been. And I started out just like you. I've got a degree in mechanical engineering. I've got a focus on automatic controls, which is the marrying of electrical and mechanical engineering. I've also got a strong background in commercial business and investing. And in the last 15 years, I've focused heavily on something called accelerated learning methods and techniques. That's being a teacher and being able to, with unorthodox ways, get information into my students' minds as quickly as possible. Not the traditional, lecture mode, but it's called accelerated learning methods. And I've really taken to this topic because I like people to spend as little time as possible with me and walk away with as much information as they can. Another thing to know about me is I'm probably very similar to some of you. When I started in 1997, they did not have webinars, so you had to go every weekend. You guys might remember this, where you went to the weekends and you spent Saturday for half the day at a hotel conference room listening to somebody talk about their trading. And then they, at the end, tried to get you to come back for all day Sunday for a much expensive price. And then at the end of that, they tried to get you to fly somewhere and spend a week with them, right? And I did that big time. In fact, the first year. In 1997, I spent $27,000 on seminars. In fact, I spend about that much every year just keeping up to speed on all of the topics out there. But I also gave $85,000 back into the market while making really stupid investments that first year. How does that jive with any of you? Have you had some big losses trying to follow people's programs? Right there with you. In fact, I bet you I could tell you a lot of things about which programs, even to today, are worth their weight in gold and the other ones that are worth their weight in poop, right? So the scoop is I've been there and I've done that. And I'll give you a hint. Please write this down. How I solved this problem is I noticed in those hotel conference rooms that the same schleps like me every week showed up, right? I was in Silicon Valley. I was working for Hewlett Packard at the time, earning 6 figures. I was single, had a small low rent apartment. So it was cool that I was losing this much money. I mean, what a better way to do it. I actually lost more money in the markets in those first years than I did spending on college. But the scoop is I saw the same people and I cornered them after about 6 months of seeing them. And I said, would you guys want to try to do these strategies together? So write that down. Being in an investment group is worth its weight in gold. Being able to have somebody who, or more than one person, who looks over your shoulder and tells you whether you're, out to lunch when you think you see a pattern is invaluable. So do that. The last thing I want to tell you about me before we get back to the strategy is my foundation. I always like to talk about my foundation. I started it in 2003. This is where I took 14 inner city gangbangers off the street of Denver, and I taught them how to trade this exact strategies that we're talking about today. I call it my investing turtles experiment. I'll have you know, 5 of them did wash out of the program. They just stopped showing up. But 9 of them continued, and here's the gotcha. None of them had computers. We had to go to the public library, and we had to use their computers. They made us get off the computers every day after 1/2 hour. So if these gangbangers could learn this strategy and pull it off using library computers that they only got access to a 1/2 hour a day, anybody can do this, I'm telling you. And I'll tell you, all 9 of those folks that stayed in the program, I gave them each 2,000 of my own dollars, thinking that I was just going to write it off. I wasn't going to see any of that money again. They all paid me back. They all bought themselves their own computers. At the time, they all got themselves DSL high-speed connections. And one of them even was able to take his trading income and put himself through Denver University, DU. So I am so proud of these folks. But we started this foundation, and it has since grown. In fact, last year we graduated 170 kids. We've actually partnered with the Chicago Board of Options Exchange, and we've moved it from Denver to Chicago, where we're working with inner city kids from the south side of Chicago. I'm sure you've heard about them on the news if you're not even have personal experience with them. So I'm very proud of this. And just so you know, everybody you ever talk to at my company, which is called Trading Trainer, we donate our time to Trading Trainer, meaning we teach you guys and anybody else who joins our programs, and we don't take any of the profit. If you often look around at some of these programs that you're offered and you think, oh my gosh, they're charging me $500, $1,000, and you count how many people are buying that program, you might realize that a lot of the people who are selling you those programs haven't traded in a while because they found out how profitable selling you guys education is. Or some of the folks haven't traded at all. I'll have you know that everybody you talk to at Trading Trainer donates their time because all of the profits of my company goes to my foundation. So that's something important, because then you know if you're talking to me or Coach Jay or Coach Leo or Montana or Coach Megan or Coach Neil, you know that we're making our money through trading and not by teaching you. Okay, back to our program at time. I got to be very careful of the time, so I'm going to watch it carefully. I might speed up a little bit with my words. Please have your pen and pencil ready. Let's go. What minimum returns must you make monthly on your portfolio to more than double your money annually? This is just a review, making sure you're on the ball. 0.5%, 1.5%, 5%, 6%, or 10%. Write the answer down on your piece of paper. If you said 6%, you're right on. We focus on 6%. Now, I'll give you a little hint. The people in my program that do this premium selling we're talking about today are making more than 6%. They're making double digits, anywhere from 10 to 16% per month. And that means we're doubling our money every 4 to 6 months rather than every year. But we aim for 6%. We aim for the moon to get to the stars. If we get to the stars, great. So this is the instant income calendar investments. These guys are less subject to wild swings or devastating losses. Like, for instance, what happened during the end of November, first part all the way up till the end of December last year, and then the rebound that's happened since. Our trades just continue to profit every month. It's almost like we have a portfolio or a mutual fund that we're managing that just pays these higher returns. Instead of the mutual fund being invested in commodity stocks, they're invested in premium selling of options. These investments are immune to downturns in the stock market. They can be structured to actually profit. For all of you people out there who believe the market's about to have its bottom falling out and you're waiting for that crash, these investments can actually be structured to turn into pure cash on the downward. They have built-in profits buffers. These profit buffers can also be structured upside down. And the focus is we earn more than 6% per month on your portfolio. That's the whole goal of this program, to have basically a fund that we create, that we manage, that just pays us monthly greater than 6%. So what are we actually investing in? We're selling option premium. What is option premium? Well, whenever you look at an option price, like on the CBOE big board, it consists of two components. There's an in-the-money value and there's a premium value. This in-the-money value is what is the option at expiration. So at expiration, the premium completely decays away and you're left with whatever the in-the-money value is. If you're an academic, academics like to call the in-the-money value the intrinsic value, and they like to call the premium value the extrinsic value. I like to use sort of the street names. Some people actually also call the premium value the time value. I don't use that term because there's a lot more that goes into it besides the time value. So premium value is what we're going to use today. So what we're doing when we create our portfolio of premium selling trades, well, first, before I even start that, what is an option? So this option thing that I keep talking about is a financial instrument called a derivative, right? They're typically bought and sold to hedge risk against stocks, indexes, and exchange traded funds, but that is absolutely not how we're using them. Instead, we're selling the premium. Write down these 4 strategies right now. They're very simple, but they're very powerful. One is called the covered call, writing the covered call. The other one is writing the covered put. This is flipping the covered call upside down. The third one is writing a covered call against a leap. It's kind of like a supercharged covered call writing. Somebody yesterday told me that it's the poor man's covered call writing. I don't like that term because it sure doesn't make me poor. Writing covered calls against leaps. By the way, again, if you're an academic, you might know this one as the bull call diagonal debit spread. And finally, writing covered puts against leaps. Supercharged covered put writing against, again, this is the bear put diagonal debit spread if you're one of those nerdy cocktail party talkers who likes to bore everybody. No, I'm one of those people as well. So I like to know what the academic terms are as well. One of the things I want you to notice right here, by the way, is out of these 4 transactions, they are all but one cash transactions. That means, like most of us in my program, we are doing this in our IRAs because we don't want the tax burden that goes along with it. The covered put is a margin trade, but its sister, the writing covered puts against leap, the poor man's covered put strategy, otherwise known as the bear put diagonal debit spread. This sister strategy, which behaves just like its original parent strategy, This sister strategy is a cash trade, so we can get the same benefits of the covered put and still be able to trade it in our tax deferred or tax-free accounts. All right, so I'm going to run through an example. Now, Amazon, I'm using that as an example because most of us, almost all of us, know who Amazon is. I mean, they're a major industry changer, making stores like Sears go out of business, so on and so forth, and now they're in every other. They're pretty much permeating our life. I'm using Amazon because everybody knows it. I wouldn't use Amazon in real life. This is a chart of Amazon. I've got my Thinkorswim running as I'm watching the markets today. And Amazon is not the most ideal price pattern for us to do. And also it's freaking expensive. So I'm using Amazon just to get my point across today. Here we go. If I was to buy Amazon and then sell the near term at the money call, these are prices that I picked up this morning, by the way, I'd be able to get a discount on Amazon, right? I'd be able to get what I call an instant dividend against Amazon of $6,205 per option contract sold. Option contracts have 100 shares in it. I basically am creating a coupon because this at the money option is going to wind up expiring worthless on the 21st of June. And so I'm creating a coupon that if we don't use it, if the person who gets the coupon doesn't use it, it is expiring worthless. So I'm creating this discount. I'm creating a instant dividend. So let's see what happens. If Amazon closes above 1860 on June 21st, what goes down? So we paid for Amazon 1859.48. We get 1860 when we get exercised for Amazon. So we walk away with only a 52-cent profit. Well, we also got to keep that money for selling that premium, 62.05, which brings us up to 62.57. That gives us a 3.5% profit. Now, again, Amazon isn't our ideal candidate. Again, we're focusing on 6%, but this just shows you how to sell premium like this. The other thing we like to do is we don't like to do what's called a buy right. For you academics out there, we like to leg into the positions, but still, I'm showing you how the math works. Does this make sense? How many show of hands are following? I know I'm talking fast, but I'm cramming in a ton of information. What if Amazon is flat by June 21st? If it's flat, guess what? We get to keep the premium. We make that 3.5%, and then we do it again and again and again. And this is where it becomes kind of exciting because every time we do it, you know the definition of return on investment, right? Return on investment is equal to whatever profit you get over the amount that you invested. I like to call that cost basis. Well, every cycle that you're able to do this, your profit reduces your cost basis. When you reduce the denominator and continue to increase the numerator, guess what happens to your ROI? Who remembers that graph from the beginning of, that's right, compound interest? We love that. Let's keep going. What if Amazon drops by June 21st? Everybody's worried about it dropping, right? Well, we have a built-in profit buffer of 62.05. So in addition to it being a coupon, a discount, an instant dividend, it's also a profit buffer. In other words, we can drop all the way to 1797.43 and still be profiting on this Amazon thing. So we have some room. I'm also going to show you later in the call, if we have enough time, how we can collar this position and totally insure it for any movement below. But at least it built into the strategy itself without even the collar. We've got a 62.05 profit buffer. So here are some examples of some trades we did this way. 17% on Micron when it went up, 15% on Activision when it went sideways, 14% on Allscripts when it took a dump. Okay, please answer all that apply. That means you could pick any or all. What does investing by selling premium create? Does it create an instant dividend, a discount on a security, a profit buffer, an expiring coupon? If you said all of them, you're absolutely correct.
Here's some more gains. Just because I'm watching the clock, I'm going to get through them. 21% when the stock went up, 12% when the stock went sideways, 17% when the stock took a dump. All right, so you get the idea behind a covered call, but now let's go the next step. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? What do you think? Do we sell out in time options? Do we replace the security with options trading at parity? Do we give up and buy mutual funds? Or is what I'm talking about just not possible? It's impossible. If you said replace the security with options trading at parity, you're absolutely correct. Now, I don't want you to get that confused with synthetic equivalencies. Trading at parity and synthetic equivalencies are not the same thing. Synthetic equivalencies are like if you have a credit spread, a vertical credit spread, and a vertical debit spread. Those are synthetically equivalent. Or a condor and an iron condor is synthetically equivalent. Even buying a stock or going long a call and shorting a put is synthetically equivalent. Trading at parity means, wait for it, well, first you have to get down to option premium being the most when an option is at the money. But when we go deep in the money, the option has very little premium. In other words, we target that the premium component of the price is less than 5%, and therefore the option is almost completely intrinsic or in the money value. In other words, a deep in the money option behaves exactly like the underlying security, dollar for dollar, but it's at a cheaper price. How many with a show of hands are following so far? Excellent, excellent. So how far out in time should we buy this option that's deep in the money? Well, let me give you some statistics. Our program participants over the last year, on average, have been holding their positions 4 to 5 months. Sometimes it goes over, sometimes it goes under, but on average, it's 4 to 5 months. Now, to completely vest their whole portfolio, they're in anywhere from 3 to 7 positions. Now, when you think about it, if you've got 3 to 7 positions that last 4 to 5 months each, it turns out that in any quarter, a quarter means 3 months, in any quarter, we're only cycling into 1 to 2 new positions, which is important to remember. This is not an active trading strategy. This is something where you're managing your portfolio, you're checking in the portfolio maybe once every evening after the market's closed, seeing how much you've returned since then, and you're doing very little activity. And I'll show you a real live example in a couple of moments of a trade that we did that lasted 4 months, and we did maybe 7 transactions over the whole 4 months. So it's very little work. But if our positions are lasting about 4 to 5 months, maybe 6 months, 7 months, how far out in time do we go? Well, when we're using that back month option instead of an underlying stock, we need to go far enough out in time such that that thing expiring won't interfere with how many cycles of premium we can get. We want to get exercised or bailed out before this back month option. I mean, it's like, what if I had a property and I was renting it to tenants and I was making a nice cash flow every month, and then all of a sudden the property disintegrated into my eyes, even though that cash flow was coming in? That would suck, right? Well, the scoop is we want to make sure that back month option doesn't disintegrate. So we go far enough out in time, and a lot of time there's a nice liquidity in the leaps. So right now we're just at the amount of time where we have to, think about moving past this. But right now we're using the January 2020 leaps. Leaps are long-term equity anticipation securities, basically options that expire 3rd Friday of January. So let's find a substitute that trades at parity. Do you want to spend that $1859.48 on Amazon? Or how about this Amazon 2020 1,170 call, very deep in the money? In fact, it's so deep in the money, it's got 95.1% of in the money value, only 4.9% of decaying premium value, and look how much cheaper it is, $724.73. So let's do the math. We're going to still sell that near-term at the money option for premium, but we get a discount on that cheaper
Our instant dividend stays the same, $6,205 per option contract sold. So if we go above 1860 on June 20th, what happens? Well, we get the difference between the two options. They're going to liquidate each other for 690. So wait a second. Does that mean I paid 724.73 and I only get 690 back? I get a loss. But don't forget, we also get to keep that money from selling the premium for a profit of $27.32, which still works out to that 4.1% ROI. Remember, Amazon isn't our best candidate, but it's something that everybody knows. But what happens? Here's where it gets really excited. What happens if it goes sideways? We get to keep that premium. This time, because of the lower cost basis, we're walking away with 9.4%. Do it again. And again, Amazon is one of our worst examples, just using it for its name recognition. But if you can pull something out of your worst example at 9.4% every month and do it again and again, that sounds pretty exciting. What if it drops? Same profit buffer. This time the profit buffer is on the smaller amount. It gives us even more leeway. Some more gains using this particular strategy, 43% on Yandex, stock went up, 9% when the stock treaded water, 2% on Bloomin' Brands when the stock took a dump. So now that we've talked about the covered call, we didn't talk about the covered put except for that we can convert it, but the covered put works upside down. We also talked about how we can substitute the actual underlying stock for something cheaper that behaves like the underlying stock. What about reducing that return on risk? How about collaring it? What do? Sell half as much option premium, sell out in time options, collar the investment by marrying a protective option, or is what I'm talking about not even impossible? Not even possible, impossible. If you said collar the investments by marrying a protective option, you are spot on, right? Let me show you an example. This is an example on Ericsson. Now I'm going to bring over the chart and I want to show you, this is a trade that we had from November through March, okay? You'll notice that it was going nice and sideways, and then around March it decided to start going into a higher channel. Take a look at my spreadsheet here. This is my trade log. I bought some Ericsson on November 23rd. That was when it was very low. If you take a look at November 23rd, right around here, we were just coming off of a bottom. I waited a few days until December 14th, and I decided to sell my premium. That's because the underlying symbol popped up to a high. It just passed its top. I sold that premium, and I bought for myself that January protective put. Notice I bought the $8 strike price. The cost basis right now is $8.18. What happened? The third Friday of December rolled around. It expired worthless. I got to keep that premium. Here's the cool part. A couple days later, I sold back the insurance. Now, some of you are going to get this, some of you are not. But if you sell back the insurance, and notice the difference. I paid 6 cents for the insurance. I bought the insurance at the same time I sold the premium when the underlying symbol was at a top. I sold back the premium after I hit a bottom. So I got to sell it back, that insurance, for much more than I paid for it. And the whole time I owned it, it was insuring my premium trade. If you get what I'm doing right there, I'm creating a whole new income stream on my premium trade above and beyond just the premium trade itself by getting into the insurance business, buying and selling the insurance. I did it again. By the way, I reduced my cost basis to $7.94. I did it again the next month. I sold the premium. I got 20 cents again. I bought the insurance. This time I didn't get such a good deal. I got 6 cents the first time, 20 cents the next time. But it expired worthless, the main premium. And when I did sell the insurance back, I got 25 cents. So I still made a great deal. Notice I was insuring down to $8. And my cost basis, I had knocked it down below $8. Think about what that means. When all was said and done, I did about 1, 2, 3, 4, 5, 6, 7 transactions. After the time I was in it, I wound up walking away with 24% ROI. Now, back to that topic of what does that mean when your cost basis, a couple more trades, sorry about that. I brought this particular graph back from the beginning of the call. Why? When the cost basis is less than what you're insuring it for, it means that even if the trade goes against you and you have to use the insurance, you're still going to get insured for more money than you have into the trade. It's almost as if you own a piece of property, you're renting it out, and the insurance policy, you paid $100,000 for this house to rent it out, and you have a $200,000 insurance policy. If the thing burns down, you get 200 instead of 100,000. It's insured for more than it's worth. That's called a risk-free trade, right? And the other thing you might have noticed is each month I can stay in the trade without it expiring, and I set my trades up specifically for that. Because of that whole compound interest, the profit goes crazy. Last September, I had one that lasted 7 months, and I wound up getting more than 140% ROI on the trade, just watching it pass by with time. So what do we have when our cost basis break-even price is less than our protective bailout price? A risk-free investment, a losing trade, too much complexity, or a pipe dream. If you said a risk-free investment, that's exactly it. Again, if you look at my spreadsheet, after the first month, I'm insuring for $8, but my cost basis is less than $8. In other words, I'm guaranteed, even if all hell breaks loose and I have to use my insurance, to walk away with profit. There's no more of my money on the table. It's very powerful. And then the other piece that's very powerful is selling that insurance back at a profit every cycle and always getting brand new insurance. Review the 3 steps. Write this down. Buy or short an underlying security or buy a substitute option trading at parity. Sell a near-term at-the-money option for its premium value, an instant dividend and profit buffer, and collar with a married option that is 1 month out at least. I like to actually nowadays, since it's more economical, go out 3 to 6 months, plus that's not as susceptible to IV change. Go 3 to 6 months out in expiration to protect your investment. Here's the 5 major points. Buying options, especially right now in this market, and you know how volatile this market, buying options and hoping to leverage directional moves, I would say all the way through the election in 2020 here in the States, is going to be a sucker's bet for you. It's going to be hit or miss. You'll probably wind up losing more than you gain. Whereas you could generate a serious income selling options and letting this time passing by be your profit. You can insure your positions with the collared protection for up to 20 times return on risk. And realize we are hunting for trades with a sniper rifle, not a shotgun. See, what I have found, it's impossible to screen these opportunities by hand. You can spend hours doing that, and that's why I have screeners. In fact, if I bring over a Google window and I go to my main website, tradingtrainer.com, and once I'm at the main website, first thing I want to draw your attention to, feel free to come to my website. It's tradingtrainer.com. And there is on some of the passing carousel images, download the white papers. Everything I'm talking about is in these white papers. They may be over your head, they may not be, but please enjoy them. They're my complimentary gift for you for showing up here today. But in the meantime, I'm going to go to login. I'm going to bring myself to my web portal here. I'm going to log in. Make sure I get my password right. I typed too fast. I'm just watching at the clock tick down. I want to make sure I show you everything I got to show you. So you'll notice here when I go to our premium selling screener, I get these screeners that tell me every night they run. Remember, we only need 1 or 2 positions per quarter to make our portfolio work. But every night we run the screener and we get different positions. It tells us to buy this stock, sell this call, buy this put, and it tells you the type of returns you can expect. And then, of course, we can then supercharge it by substituting in the leap. I created these algorithms that go through all the stocks, about 11,000 different stocks, indexes, and ETFs, and 900,000 option chains, and that's how we screen them in our program. Saves a ton of time. So my question is, how would you like to never miss a pick, minimize the amount of time you spend away from your loved ones, and have the hand-holding support whenever you need it? Because that's what it's all about. It's about saving time, creating clarity, and just getting the best results. So would it be okay if I took a couple of moments to tell you a little bit about my materials, training, and tools to see if they're right for you? Thank you. Thank you. This is for someone who doesn't want to pay for multiple data subscription, wants everything they need in one place, doesn't want to miss an opportunity, wants to spend more time doing other things, doesn't want to do this alone, and step-by-step instructions. Someone who wants to get consistent, reliable results. Is that you? Here's a testimonial, just very quick. Charlene had cancer. She was a teacher. They kicked her out of being a teacher when the chemo got too much for her, and she thought she was going to die, and she was totally at peace with that. And guess what? This is what really sucks, is when you have a disease like this and then you survive it and you actually recover it, and now you're screwed with medical bills and no retirement and no way to collect insurance or Social Security. So she found me, she started trading. All you do is read a daily table, find a stock you're interested, follow the strategy set out for you. I use this along with other strategies to diversify my financial plan. I recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. So awesome. Once a month live training webinar in our program, once a week webinar workshop. This is really, really cool. This is where everybody comes on Thursday nights. They bring to me a ticker they're interested in. Usually we get 5 or 10 every workshop. We pick the best of the best, and then we work it out. And at the end, I hand to you a plan that you can then go trade. People call it learn while you earn. In fact, we have people who have been doing this program for years, and I say, why do you keep doing it? And they're like, well, we could learn to do it ourselves, but every Thursday you hand us a trade that we can pursue. So that's kind of cool. We also like to, and in fact, I have a commitment for you. I like to handhold people through their first trade into this program. So make sure you call me when you're ready to do your first transaction, so I can look over it and be that person who tells you whether or not you're out to lunch. Make sure you know all about the gotchas that might be in your future. As a bonus for Traders Talk Live, we're going to make sure that you have somebody who calls you, who's been where you are, talks about where you are, where you've been, where you want to be, and shows you the fastest way to get through it. That's a bonus. And double your money back guarantee. This program is 6 months long. Do the program for 6 months. If at the end of the 6 months you're not making a profit, your portfolio is not working for you, I'll give you your money back, and I'll give you double your money back. That's how comfortable I am with this program. So here's what you're going to do. You're going to go to optionsinvesting.org, and I'm going to bring back my Google window. I'm going to actually type that in, optioninvesting.org. In fact, I think somebody will type that into the chat box. Traders Talk Live. So optioninvesting.org/TTL. And if you go there, you should see a page like this. And when you get to the bottom, the program is $497. And again, there's the double your money back guarantee. You can read about everything that comes with the program. Folks, you deserve it, and your loved ones deserve it. Feel free to reach out to me by email. I put the email up on the screen. Telephone, I'm sorry I didn't get to any of your questions. I told you this was an hour presentation, squeezed into 45 minutes. Thank you very much. Please
go to optioninvesting.org/TTL. I'll see you tomorrow in our workshop. Take care, everyone.